Good afternoon, everyone, and a warm welcome to KPMG Middle East and Southeast Asia Global Minimum Tax Webinar. I would like to introduce myself. My name is Rashid Al-Qina'i, Head of Tax, KPMG Middle East and Southeast Asia. I would like to take this opportunity to wish you all a Happy New Year. As we enter 2022, we know that the new year brings with it challenges and opportunities. And despite the continued disruption, everyone is hearing me? I just want to make sure the speaker is correct. Yeah, so the work of international bodies such as the OECD goes on. In fact, the OECD is still working hard to meet the ambitious deadline for the OECD Pillar 1 and Pillar 2 proposals. And we clearly saw some major political and technical progress on the Pillar 2 proposals during summer and winter last year. As ever, the pressure on tax transparency and compliance continues to increase, with countries adopting aggressive tax avoidance measures, including unilateral actions wherever required. The EU has already mentioned that unilateral measures will be adopted where a global consensus is not reached on BEPS 2 this year. With a draft Global Minimum Tax Directive already drafted and announced and public country by country, due to take effect from 2025, for taxpayers with a calendar year end. The impact of BEPS 2 tax proposals will be felt globally, and whilst the degree of the impact may vary across jurisdictions, we expect that the Pillar 2 proposals will have a significant impact in the Middle East, where we continue to have a number of countries that A, don't have a mainstream corporate tax, B, have a corporate tax rates below the minimum rate, C, have a hybrid corporate tax or zakat systems in place. To address this significant impact, we have organized today's session, take you through some of the key changes announced and that this means for what this means for your organization. To do this, I'm delighted to be joined by KPMG experts during today's session, including international tax and transfer pricing partners Shabana Begum, Nilesh Ashar, and Transfer Pricing Director Estina Delivan on the call. I am also delighted to be joined on this webinar by our Head of Tax in Qatar, Barbara Hansen, Head of Tax in Kuwait, Zubair Patel, Stefan El Khouri from KSA, and Umar Hisham from Bahrain. Last by no means least, I am delighted to have Stuart with us, who is the Head of Tax with KPMG UAE and will be moderating the Q&A session today. In terms of the agenda for today, we are looking forward to providing you with, firstly, recap of the proposals and proposed timeline. Secondly, an update on the recent announcements. Thirdly, and perhaps most importantly, what the impact of these proposals are for the region. And finally, we will look at what next steps you should be undertaken to prepare for the changes. However, before we go into the technical details and impact areas, I would like to hand over to Stuart, who will cover a few administration points. Stuart, please, back to you.
Yeah, thank you, Dr. Rashid, and welcome once again, everyone. It's great to see so many of you joining from across the MESA region, and we look forward to seeing you in person at our annual MESA Tax Conference, which will be held in person on the Thursday, the 12th of May, 2022 in Dubai. Further details will be coming out over the next coming months, but 12th of May in Dubai. Today, however, the focus of this discussion is on the global minimum tax, and I know this is a significant area of interest for a number of you today. Whether you are a Middle East headquartered group or you're part of a foreign headquartered group with regional presence, the rules are going to impact you and no doubt feature on your board and potentially audit committee agendas. Given the focus we now know this topic is getting across our client base, we know you will have a lot of questions, and as a result, we want to give you the opportunity to ask those questions today. So please ask any questions you have in the chat box below your presentation screen, and I'll do my best to ask Shabana, Nalesh, and Istina, and our other MESA country heads of tax to address these during the presentation. If we do not get the opportunity to answer your questions during the webinar, we will ensure a member of our team will follow up with you with a response to your question. Now, I am delighted to hand over to Shabana, who will walk you through some of the details. Thank you, Shabana.
Thank you, Stuart. And welcome once again, everyone. I think before we get into the technical details of the rules, and for those of you who have seen some of the releases that happened during last year and during December in particular, you'll be aware that the rules are very complex. Now, I think it's fair to say we're all used to some degree of complexity with tax law, but I think this is setting a new benchmark, both from a compliance perspective and then also in terms of a mechanical perspective as to how you apply the rules. But as a recap, I think just to take a step back, we are now, as of today, at a place where 137 countries have now endorsed the proposals out of the 141 Inclusive Framework member countries. Now, I will focus for a short while on Pillar 1. Now, whilst that isn't of relevance to a number of you on this call, it is still worth noting it is such a significant departure from the existing tax rules that we have. And that's, of course, to align us with what's happened in the global economy over the past few years. Where this does apply to groups, it will impact their reallocation of profits, but of course, it will only apply to the world's largest groups, so those with revenues in excess of 20 billion euros. So if you're part of one of those groups, I'm sure your parent jurisdiction is already reaching out to you from a data perspective and also trying to understand what this means. By our estimation, we reckon there's about 5 to 7 groups in the region that will be impacted by Pillar 1. And it's worth noting there are a couple of exemptions here. So both whether you're a regulated financial services group, in particular the banks, or if you have any extractive industry as part of your group. But the title of this webinar today is the Global Minimum Tax, or also known as Pillar 2. And that's really the focus of the agenda and the priority for a number of groups. Of course, this is because it applies to a much larger group of companies, given the turnover threshold that's applicable here is much lower. So it's 750 million euros. And the 15% rate that has been in the press for a number of months now, it's got a lot of attention. But it's worth noticing that the subject to tax rule, which forms part of Pillar 2, also applies a 9% withholding tax rate, an effective withholding tax rate on certain payments. Now, we'll come on to what that means in a moment, but in terms of the exemptions, I think it's fair to say that the exemptions both for Pillar 1 and Pillar 2 are fairly limited. So unless you meet the excluded entities definition for Pillar 2 purposes, or you have an entity in your group, you will be in scope of Pillar 2 provided you meet that revenue threshold. Now, if we move to the key aspects of Pillar 2, I think what I'm about to tell you in this slide is maybe already very familiar to a number of you, depending on where you are with your Pillar 2 journey. But it's worth noting in terms of the mechanism of how Pillar 2 will apply, it still will apply by way of now 3 different rules. So the primary rule continues to be this income inclusion rule, which is effectively a CFC type mechanism. But it's worth noting there is now an option for jurisdictions to have a domestic top-up tax included as part of the application of the IIR. And that's a huge change from what we saw as part of the October 2020 blueprint. And that's essentially designed to ensure that any taxing rights that would have been lost or ceded to another jurisdiction can now be picked up in a low tax jurisdiction if they apply this rule. There's the undertax payments rule as well, which has become much more robust in nature, and Nilesh will walk you through what that means in a moment. And for those of you who have been following the rules, you'll be aware that the subject to tax rule, again, it features in the blueprint, but there is one missing here, and that's the switchover rule. And the reason the switchover rule is missing from the December release and from any subsequent releases post 2020 is because of how the other 3 rules have been designed. So effectively, these 3 rules are considered effective enough to now pick up a top-up tax. We've covered the revenue point already, but I think it's worth noting that, of course, countries do still have the option of introducing a lower income inclusion rule for groups that are below the 750 million threshold, which brings me nicely to my next point, and that is the fact that whilst these rules have been endorsed by 137 countries, the OECD is very cognizant of the fact that they should not be enforced on jurisdictions. However, they are to be required to be applied under a common approach. So therefore, countries that have signed the proposals but choose not to implement the rules are still required to accept and respect the application of the rules by other jurisdictions. On the exclusions, again, I think the main point to note here is the fact that there is very limited exclusions if you are undertaking a commercial trading business. So whilst they may seem like there's a few bullets for those of you who have seen the release, it's actually, even for the sovereign wealth funds, it's at the very top holdco level and it's not filtering down to the commercial trading businesses. And again, I think on the 15% rate, it's been everywhere, even on the news from a tax perspective on this. But of course, in terms of the base, the numbers are very much focused on your financial accounting income. That is the start of the analysis. And I think on the last 2 points, both the subjected tax rule and then the rollout, of course, whilst we have had some developments, there is some further developments to be expected. And we'll see that now on the next slide from a timeline perspective. So I think, again, everybody is on a very different journey when it comes to Pillar 2. And that's in line with obviously some of the developments we've seen from the OECD. I think a year ago, if you had asked us, would this actually happen so quickly? I think it'd be hard to say yes. But of course, the political agreement that we had during 2021 significantly changed that. So it was those July and October statements that really gave the momentum and the authority to the OECD to release these global rules. We are expecting commentary toward the end of next month, so that would most likely to be February. And then we'll have the subjected tax rule and the multilateral instrument that will support that to be effective during the course of 2022. So probably about 4 or 5 months from that point as of today. And then we have a number of administration requirements. So how you file your return, the mechanism around that, the confidentiality around that, that will all be released towards the end of the year. So the intended and the highlighted date here remains January 2023, and which is when we are expecting this to be certainly introduced in a number of jurisdictions. But of course, as with all legislation, there is a possible deferral for some countries. And of course, we know that the UTPR will not be targeted to be into effect until 2024.
And Shabana, Stuart here, I mean, obviously, there's a lot to be done this year. How realistic is a 23 start date globally and also in this region? If you look at KSA, for example, there's still a lot of transition in progress. I mean, how realistic is that 1st of January 23 start date?
Yeah, I think that's a fair question, Stuart, and it's a question we keep getting from a number of groups. I think it's fair to say, and I'll let Stefan comment on the Saudi perspective in a moment. But I think from a global perspective, it's fair to say there is a significant amount of work left to be done until the 1st of January 2023. So it's only fair people have their reservations. However, we do have that, importantly, we do have that political agreement. And for many of you will have seen 2 days after the release, we had the EU draft directive issued. And for those of you who are following the global developments, you'll know that Switzerland, who is supposed to be a late adopter of the rules, has already announced their intention to adopt by 2024. We now have a public consultation in the UK that they will adopt or intend to adopt by April 2023. So I think because this is, and it goes back to the rationale behind these rules, because it is an actual cash tax paid, I think we will see a significant minority implement by 2023. And of course, some others, particularly in the region, may wait till 2024. Stefan, do you want to just add on this KSA point?
Yeah, sure. Thanks, Shabana, and thanks, Stuart, for that question. Yeah, so from a Saudi perspective, I can confirm that this is high on the agenda of the tech authorities, and not only the tech authorities, but also other ministries that are involved in, let's say, the foreign investments and they are currently doing kind of an impact assessment to see what are the implications of these regulations. And I would agree with Shabana that a rollout in 2023 for me is still a bit unlikely, but again, in this region, you can always be positively surprised that things can turn around quickly. But if I need to bet, I would say I would more bet on the 2024 implementation than 2023.
Yeah, I think, Stuart, the only final point I'd make here is that, whilst our region may wait until 2024, it would only take one jurisdiction within your structure to obviously implement the rules for you to have to be required to calculate those effective tax jurisdictional rates and to obviously submit the return. So I think the fact is that it just takes one, and the level of work and effort required will be the same as if 90% of countries in your structure had implemented.
And Shabana, just while we're here, a couple of questions have come in around the UAE. Will the UAE implement in 23? And we're talking about the GMT here. And who will administer it? Will it be the VAT? Will it be the FTA, like the VAT, or is there any announcement been made on that?
Yeah, so I think from a UAE perspective, of course, there's still no announcement on this aside from the fact that they have signed the proposals on the global minimum tax, so they're a fully committed member. In that respect, I think, again, just looking back to the rationale, the policy rationale behind this rule, it is to encourage, especially with the introduction of this domestic top-up tax, it is to encourage countries, even where they don't have a sophisticated tax regime already in place, to essentially pick up those revenues in countries. So I think if the UAE wanted to maximize their revenue opportunities and do that at a time, obviously, when we're in a pandemic, I think this is the perfect opportunity to do that. And we'll come to what this means for our region towards the end of the presentation in a bit more detail. But I think from an administration perspective, I think, yes, like, it would seem that the FTA seems like an obvious body to be able to administer this task, given its remit. However, just like with groups and the resourcing question around, do people have the right skills and the right talent to be able to meet these compliance needs? I think that's going to be a very valid question for the FTA and all tax administrations going forward.
Okay, just one other question that came in, and I think the answer to that is Pillar 1, the extractive industry exemption includes the oil and gas industry, which I think is correct.
Well, it includes all upstream activities, so essentially, yes, exactly. But I think there will be, even for the biggest groups, there's a analysis that needs to be done as to where in the supply chain does it stop becoming an extractive industry and moves to more downstream activity.
Thank you, Shabana.
Okay, so with that, I'll now hand over to Nilesh, who will walk you through some of the key developments during December.
Thanks, Shabana. Just going into the rules in a bit more detail. I think before I start off on this slide, I think it's fair to say that there's been a fair amount of departure in the model rules from the original blueprint in many respects, and we'll try and address some of those. Also, the rules are quite complex in its application of the various terms. So the idea is not to go through the complexities, to go through all of the complexities on this webinar, but just take you through broadly the scope and how it is expected to operate. The global minimum tax is expected to operate to groups in the region. We also have some examples on potential application of the rules to MISA headquartered groups, which we'll run through as well. So to start things off, the scope of the global minimum tax, it applies to MNE groups with a consolidated revenue threshold in excess of 750 million euros. And consolidated revenue is what is that is included in the consolidated financial statements of the ultimate parent entity. So very similar to a CBCR threshold that many of you may already be aware of. And a permanent establishment, even though it may not be preparing standalone financial statements, is considered and deemed to be part of the group. A departure, moving forward, the departure in the final rules from the blueprint rules is that the 750 million euro threshold applies in a 4-year testing period. So if you exceed that threshold in at least 2 of the 4 previous fiscal years, you are in scope of the regulations, as opposed to a CBCR threshold, which only tests the revenue threshold in the previous fiscal year. There are complex rules around mergers and demergers, and how do you look at whether the thresholds are met in the course of mergers and demergers that happen, or arrangements that happen in the testing periods. There are certain exclusions from the rules. So, and there's a question on that that's come on in the chat as well. So government entities are excluded, but only those that do not carry on a trade or business. So government entities, provided they carry on the sovereign functions and investment activities, non-profit organizations and pension funds are excluded. Investment funds are also excluded. However, in departure to the blueprint rules, investment funds are excluded only when they are the ultimate parent entity of the group, as opposed to an entity that sits somewhere within the group structure. However, it's worth to note that any investments made by the investment funds in a multinational group that otherwise meets the 750 million euro threshold that we just talked about, the investee MNE group is still within the scope of the rules, although the investment fund itself is not subject to the rules. Even investments made by government entities and investment funds via holding SPVs are also included within the scope of the exclusions. It's fair to say that while the excluded entities are excluded from the purview for the purposes of the application of the rules, they are within the scope of the rules for the purposes of determining the 750 million euro threshold. The other set of exclusion is for international shipping business. So any income from international shipping and ancillary shipping activities are excluded from the provisions of the Globe rules. And international shipping is essentially movement of passengers and cargo across international waters, and not just within the domestic inland waterways of the jurisdiction. One of the conditions for satisfaction of this exclusion is that the strategic or commercial management of all the ships must take place by constituent entity within that jurisdiction for the exemption to apply. And I think last but not the least, from a scope perspective, there is significant level of annual compliance that the rules bring in compared to what was there in the blueprint. So every constituent entity in a jurisdiction needs to file a Globe information return within 15 months of the end of the reporting year. The filing can be designated or delegated to a local designated entity within the same jurisdiction. Alternatively, the UPE, the ultimate parent entity of the group, can also file a single consolidated Globe information return, provided that the jurisdiction has a qualifying competent authority agreement with for exchange of that information with tax authorities in other jurisdiction. The level of information that needs to be reported in the returns is likely to be detailed, but is expected to include information around the ETR calculations for every jurisdiction, and the allocation of the top-up taxes to the various constituent entities within the group structure, and also a record of all the filings and elections that the rules require you to do. So this is likely to become an annual compliance going forward once the rules are in effect. Moving on to the next slide, some of the key changes in the rules, in the final rules from the group blueprint that we've discussed previously in our earlier webinars. There is reference to a domestic top-up tax, which is core to the implementation of these rules. So to the extent there is low tax income of a constituent entity in a particular jurisdiction, the jurisdiction has the right to apply a domestic top-up tax on that low tax constituent entity, as opposed to losing the right to tax those revenues to a parent entity under an income inclusion rule, which is similar to the CFC rules. The UTPR rules have been strengthened under the model provisions. So previously, UTPR applied only by virtue of denial of deduction for related party payments in the jurisdiction that's making the payment to a low tax constituent entity. But they've expanded the scope of UTPR to apply it to deny the deduction, not just for related party, but also unrelated party payments, and or by deeming additional taxable income or by introduction of a new tax in the UTPR jurisdiction. There are additional safe harbors that are expected to be finalized in late 2022. So there is the expectation that certain administrative reliefs will be issued, and we should hear more about that during the course of this year. There is a de minimis exclusion. So to the extent there is a jurisdiction where constituent entities within that jurisdiction have a global revenue less than 10 million, 10 million euros, an average globe income of less than €1 million, it's a cumulative condition, then that jurisdiction is excluded for the purposes of calculating the low tax income within that jurisdiction. The ETR calculation probably has one of the biggest changes in the final rules compared to the blueprint rules, and essentially there is use of deferred tax accounting has been included in ETR calculation, something that was notably missing from the blueprint rules. There are additional rules around jurisdictional blending for minority-owned interest and JVs. So to the extent you have a minority-owned interest in a constituent entity, which is 30% or less, or where you've got JVs, which are 50% or at 50% levels, those entities and joint venture groups have to be treated separately for an ETR calculation and for allocation of the top-up tax under those rules. In terms of the steps that you follow, moving on to the next slide, broadly, there are, the regulations refer to 5 broad steps, but there are 7 that we've broken this down into. The way you look at applying the GLOBE rules is determining, number 1, what your GLOBE income is on a jurisdictional basis. So you look at all the constituent entities within that jurisdiction, look at the net profit as per their financial statements used in preparation of the consolidated financial statements, make certain adjustments to determine the GLOBE income. Once you've done that, you look at what are all the covered taxes within that jurisdiction applied for all the constituent entities that are located in a particular jurisdiction. And covered taxes, you would essentially look at your current tax expense to start with and make certain adjustments, including in respect of deferred tax accounting and exclusions for taxes that relate to income that have also been excluded in step 1. Once you've done step 1 and 2, you calculate your jurisdictional ETR in step 3, which is essentially your covered taxes divided by your GLOBE income. If your jurisdictional ETR is 15% or over, then that jurisdiction does not have to calculate any additional taxes because that jurisdiction has paid a minimum level of tax at 15%. However, if the jurisdictional ETR is below 15%, you need to calculate your top-up tax percentage for that jurisdiction, which is really a minimum ETR at 15%, less the jurisdictional ETR, which you've computed in step 3. Once you've got your top-up tax percentage, you determine the profit on which that top-up tax percentage is applied at, which is essentially your GLOBE income determined in step 1, minus certain reliefs that have been given under a substance-based carve-out. And that essentially is in respect of a certain percentage of tangible assets and payroll costs that you incur in a jurisdiction. So to the extent you've got employees and assets in a particular jurisdiction, a 10% of payroll and 8% of tangible assets carrying value is deducted from the GLOBE income. And these percentages are expected to taper over time to a 5%, to settle at a 5% threshold over a transition period. But essentially, you get a deduction for all the substance you have in a particular jurisdiction at certain levels. The excess profit that you compute under this step is then multiplied by your top-up tax percentage that you look at in step 4 to calculate your jurisdictional top-up tax. So in respect of, if in any of the GCC or countries or any of the jurisdictions where you have a low tax base, your jurisdictional top-up tax is the top-up tax liability in respect of that low tax jurisdiction that you've computed so far. Now, once you've done that in step 6, the payment of that jurisdictional top-up tax is discharged by either a qualified domestic top-up tax, which is top-up tax applied in that jurisdiction, or by a qualified income inclusion rule taxed at the level of the parent entity of the jurisdiction, or is apportioned to one of the constituent entities or subsidiaries under the UTPR rule to the extent which essentially operates, as I mentioned before, through a denial of deduction or deeming an additional amount of tax. Now, appreciably, the rules are complex in its calculation and in its application. What we've tried to do in the following slides is to essentially look at a few examples through which some of these IIRs and UTPRs can be explained, and I'll invite my colleague Estina to run through some of the examples on IIR and UTPR.
Thank you. So for the purposes of illustrating the manner in which these rules may apply, we have presented here 3 case studies. The first case study looks into the application of the income inclusion rule. We have a KSA headquartered group, which has 3 subsidiaries in the UAE, Bahrain, and Egypt. In this example, KSA, UAE, and Bahrain are considered low tax jurisdictions with effective tax rates below 15%. And Egypt is considered a high tax jurisdiction with an effective tax rate above 15%. Whilst the zakat rate in KSA is 2.5% of assets, for the purpose of this example, we have assumed that this is equivalent to an effective tax rate of 7.5%. And we also have assumed that KSA has introduced globe rules together with Egypt, and UAE and Bahrain have not introduced globe rules. Now, if we look at this example, the findings are basically because KSA adopts GLOBE's rules, a domestic top-up tax is payable in KSA with respect to the KSA company low taxed excess profits, and the top-up tax rate is the difference between the minimum tax rate of 15% and the effective tax rate of 7.5%. Because the KSA company is the UPE of the group, KSA company has also the right to tax the UAE's and the Bahrain company's top-up tax under the income inclusion rule in KSA. And it will pay tax that is equal to its allocable share of top-up tax of the Bahrain company, which in this example is 90%, and the UAE company, which is 100%. Because Egypt has an effective tax rate above 15%, Egypt's excess profits will not be subject to an income inclusion rule. It's worth mentioning that the effective tax rate is calculated on a jurisdictional basis. So, for example, in the UAE, if there will be more than one company and there will be companies operating in free zones or no free zones, a jurisdictional effective tax rate will be calculated. And if that is below the minimum rate of 15%, it may be picked up under an income inclusion rule. We have a second example when we looked at partially owned parent entity in the UAE. So the example illustrates a KSA headquarter group with a subsidiary in UAE, Qatar, Bahrain, and Egypt. As the previous example, the UAE, Qatar, and Bahrain are low tax jurisdictions, and Egypt is a high tax jurisdiction. KSA and UAE, together with Egypt, have introduced globe rules, whilst Qatar and Bahrain have not introduced globe rules. In this example, the top-up tax of the KSA company will be picked up under the domestic top-up tax regime in KSA, because KSA has introduced globe rules under this example. And because the KSA company, although is the ultimate parent entity of the group, because it does not own more than 80% of the UAE company, the taxing rights drop down to the intermediary parent company, which is the UAE companies in this example. And this gives the UAE company the right to be allocated a top-up tax of the Bahrain and Qatar companies under the income inclusion rule. And these are equal to the allocable share of top-up tax of 90% in case of Bahrain and 100% in case of the Qatar company. Because UAE in this example has also introduced globe rules, the UAE company will also pay domestic top-up tax on its own low taxed excess profits in the UAE.
I think if I can just add one point to this and the previous example is that in the context of Bahrain Go, while only 90% of its top-up tax gets allocated to UAE, because it owns 90% of Bahrain Co. Effectively, 10% of the top-up tax could go untaxed in Bahrain Co. unless the balance 10% constitutes a minority-owned constituent entity rule, which is more detailed. And so it is possible that 10% goes untaxed in these two examples.
Yeah. Now we have the last example, which shows an income inclusion rule and the under tax payment rule application in tandem. So in this example, we have a UAE headquarter group with subsidiaries in KSA and Bahrain. In this example, the KSA subsidiary owns further a Qatari company, 68% of a Qatari company. And KSA has introduced globe rules, including domestic top-up tax, whilst Bahrain, UAE, and Qatar have not adopted the globe rules. In this example, the top-up tax of KSA will be picked up under the domestic top-up tax regime in KSA, assuming that, similarly as the previous example, the effective tax rate of the KSA company is below 15%. As a parent entity of the Qatari company, KSA company will also pay top-up tax under the income inclusion rule on 68% of Qatar's top-up tax. The remaining 32% of the top-up tax with respect to the Qatar company's low taxed excess profits, as well as the low tax excess profits of Bahrain and UAE company, are taxed in KSA under the under tax payment rule. Everything, so 100% of the under tax payment rule top-up tax will be payable in KSA, given that KSA in this example is the only jurisdiction on this group's footprint that has introduced under tax payment rule. It's worth mentioning that the under tax payment rule being applicable from 2024 onwards, in this example, if KSA will introduce globe rules from 2023, the under tax payment rule will only be applicable from 2024. So in 2023, it will not, the KSA company will not pay an under tax payment, would not pay a top-up tax under the under tax payment rule.
I think Christina, just one other point before you talk about what MESA countries might do. I think the only other point I'd make is that in respect of these examples that we've run through, the outcome under these examples could and would be materially different in years going forward, as and when the different countries start introducing or implementing the globe rules in their domestic legislation. So even though the countries may or may not implement in 23, as they start implementing in 23 onwards, the outcome of the allocation of top-up tax could be different in different years for the same set of structure and same fact pattern.
Yes. Yes, exactly. Yeah. As Shabana mentioned earlier, these globe rules are designed as a common approach. This means that the inclusive framework members are not required to adopt them, but if they choose to do so, they should implement them and administer them in a way that is consistent with the model rules. From the table provided below, most of the countries are members of the inclusive framework and have signed up to the globe rules. With the exception of Kuwait, which is not a member of the inclusive framework, and Pakistan and Sri Lanka, which have not agreed to the globe rules.
Thanks, Nilesh and Christina. I might just on that's a good place to stop and just bring in some of our country experts. And I might start with Omar and Bahrain, and maybe just give us a bit of a view of what the Bahraini authorities are likely to do now we have the OECD rules in place.
Thank you, Stuart. So in Bahrain, as you may already know, Bahrain has already implemented the economic substance reporting and introduced the CBC reporting sometime early last year, 2021, February, with the aim of doing the first submission for CEs, local CEs, by the end of last year, 31st December 2021. That's only for notification though. But recently, the MYCT, or the Ministry of Industry, Commerce and Tourism, has reached out to some of these businesses and informed that the the CBC notification has been extended up to 28 February 2022. So we're yet to see how the format of the form or reporting is going to look like, but we expect that to be coming out soon. So now, based on this, we expect Bahrain to introduce a corporate tax regime in the next 1 or 2 years. We expect it to follow what other jurisdictions in the region are currently doing or will be doing, notably the UAE. It's likely going to be a broad-based corporate tax, not differentiating between a GCC entity and foreign entity. So far, in terms of the market, Stuart, some of our clients, especially those with part of an MNE, they've come to us and asked us to probably do a corporate tax simulation exercise just to help out on trying to do a budgeting, part of their impact assessment or gap analysis. So far, the globe rules is concerned and corporate tax regime in Bahrain is concerned.
No, you mentioned the next couple of years. Are we talking January 23 or January 24?
January 24.
Okay, January 24.
Yeah.
Thank you.
Yeah. Well,
and thank you for that, Naman. Appreciate it. And maybe I'll bring Barbara in to give us the view from Qatar. And Barbara, I'm pleased to see that the World Cup tickets have finally gone on sale this afternoon.
Yes, definitely. So I tried to apply, but it's still a little bit difficult. So when it comes to Qatar, what we have seen, and probably this is also in connection with the World Cup, that Qatar has moved very, very fast. So we were probably, as a second country in the region, CBCR was adopted. Transfer pricing, full transfer pricing documentation requirement has already been implemented. When it comes to the global minimum tax, the different tax authorities in the country, they are currently, having discussions, looking at what would be the impact for the bigger local companies, also the international companies. But in general, I expect that we will see big changes in the tax environment in Qatar. So at the moment, everything is at stake. So even the Qatari exemption is under discussion. So that's no longer something which cannot be touched. And also, it's possible that the tax rate will increase to 50%. So we really see at the moment, everything is possible. When it comes to timing, I would say Qatar will definitely not be the first mover. So they will, they will be very active. They will negotiate, but they will wait what other countries in the region, specifically, I think KSA and UAE are doing, and then follow probably.
I think, Barbara, that's great, and I'll let you get back to the ticket website, and maybe just talk to Zubair, Kuwait. Now, Kuwait obviously hasn't signed up to these initiatives, so I'd be interested to get your perspective on the likely response from Kuwait.
Yes, Stuart, thanks. I mean, I think that's something, for me, having been in Kuwait for a few years, normally Kuwait, when the rest of the GCC moves, it normally follows suit. So I think it's one of the few areas where I find that Kuwait, unlike the other GCC country, hasn't supported that. So that's definitely, an anomaly. But having said that, I mean, there is a 15% tax. Obviously, the table is stating for the foreign companies. So there has been a discussion, but at a very nascent stage, whether the 1% zakat tax should be replaced by the 15% because the regime is already there. But obviously that's at a very, very early stage. But I also feel that, Kuwait normally moves with the other GCC countries. So I think remains to be seen that over the next couple of years, they may follow suit in this regard. But currently, there's nothing on the CBCR, neither on the TP documentation. So we're a bit behind, but yeah, so I think it's wait and see. Not hearing a lot from the Ministry of Finance on that. But there is a CIT regime in place. So I think if it does happen in Kuwait, normally I've seen with the zakat regime, it came within 2 months. So if it does happen, it is going to happen very quickly here.
No, thanks, Zubair. And look, obviously in the chat box, there's been some questions around the UAE, and I think Shabana has answered that in the Q&A box, which, the likely response from the UAE MOF. Obviously no announcements to date. The only key thing is that the UAE has signed up to these proposals and therefore is expected to accept these proposals. But I might just bring Shabana in quickly before we move on, Shabana. But the question's just come in, and I think it's a good question, that if a jurisdiction doesn't do anything around a broad-based CIT, does it have an option just to introduce the Pillar 2 rules on its own?
Yeah, and I think had this question come up pre-December, I think it would have been difficult to say yes to this question. But I think what we saw with the December release was this introduction of this domestic top-up tax, and therefore it does actually, actually bring in the option for jurisdictions, which is obviously something that is very welcome by low tax jurisdictions, to bring in a measure quite swiftly on a simple basis. So obviously the model commentary would come from the OECD to do this, introduce this into domestic law and therefore not lose out on any revenues. And then maybe some of you on the call thinking, well, that sounds a bit unfair and a bit discriminatory. But I think from an OECD perspective, they've always been, very comfortable with the fact that, for example, KSA and Kuwait apply different tax rates to their own GCC or local corporates or shareholders. And that's always been acceptable to the OECD because essentially the major risk that the OECD tries to fight is where you have a preferential regime for foreign corporations, and therefore are incentivizing those foreign corporations to relocate away from their parent jurisdiction. So I think it has become a real possibility. But of course, whether the UAE wants to limit, or other Bahrain or others in this region, whether they want to limit their tax take just to Pillar 2 at an opportunity where they could obviously apply a much broader corporate tax remains to be seen.
And Sean, I think that is one of the questions around SMEs. What's the impact of an SME? And obviously, if there's nothing is brought in, then there is no impact. But if a country brings in a broad-based corporate income tax, then that's when the SMEs will be caught. There's a question here about data on how many companies might be in the threshold limit of Euro 750. Look, we in the UAE do have an estimate. We think there's about 60 groups within the UAE that will be caught by the Pillar 2. But also importantly, there's a lot of inbound foreign MNCs which will be in not only the UAE but in the region who will be subject to these rules as well. So, but UAE-based groups, we estimate around 60. I can't talk for the rest of the region, but we can try and find that data for you and circulate that later. Okay, with that, I will. Shabana, do you want to sort of? We'll have a little bit more time for questions in the end,
Sure.
but maybe Shabana, you want to talk about what are we expecting and the next steps?
Yeah, absolutely. So just moving on to in terms of what are we expecting, I think we addressed a couple of these points during the presentation already around timeline and particularly the OECD releases. But of course, I know for many of you, and it's evident in the chat box and the conversations we have with you, that the real big change for everyone here will be around what happens at a regional and a local level. And because I think whenever we speak to clients, the main concern is, well, both this will be a very big shift in mentality from going from very little tax compliance to obviously a more traditional European or Western type of tax compliance. And then on top, obviously, you've got the global minimum tax. So I think this is a huge issue for a lot of groups. And whilst there's no official announcements from the governments yet, I think it's clear that this is not like anything we've had before. This is not country by country reporting. This is not ESR. This is an actual tax that needs to be paid. And so I think every Ministry of Finance in this region is really weighing up now the balance between being an attractive and a competitive place to do business, but also wanting their share of that 15%. So I think we will see announcements. We probably will see them this year, maybe even this quarter for some of these jurisdictions. Obviously, the detail of this will vary by jurisdiction. But I think the first mover clearly in this may well, as everyone does expect, to be the UAE, and then I think we'll see the likes of Bahrain and Qatar, Kuwait, etc. follow suit. In terms of the OECD releases, we still, of course, have the commentary on the global rules to be released. So our second point here, and for those of you who have read the rules, and I've made this point a few times now, is that they are very dense, right? They're not easy. It's not an easy read, and it's also not very helpful not to have any illustrative examples. So we're hoping some of these complex provisions, particularly around joint ventures and transitional arrangements, for example, are clarified as part of the commentary that gets released next month. And then also the same sentiment with the subject to tax rule. So again, the treaty provision, the MLI that needs to be designed around this, obviously all needs to be released towards the middle of this year. Again, a very ambitious timetable by the OECD, but we know they've got the political consensus behind them, particularly from Europe. So I think we will see some progress here. But the last point, and I think this is a point that's going to be on many of your minds, is really around the administration. So, you know, unlike obviously VAT or other similar types of taxes, the return for this global return won't be due in the first year, at least for the first 18 months. Although for those of you who have seen the wording on the EU directive, that actually says it's 15 months after the calendar year end. So we're looking at a 2025 date for filing and paying any taxes under the global minimum tax. And, you know, whilst that seems quite far away, I think the reality is that to make any restructuring that you need to do, to make any changes to your transfer pricing, obviously that needs to happen sooner rather than later, not in 2025 when it's too late. And the final point I'll make here is really around the penalties. So when we were looking at CPCR penalties, for example, it's clear that the world has taken a very different view on whether it's a minimum, you know, nominal penalty or a significant penalty where you go to prison in the Netherlands, for example. I think with the Pillar 2, it's going to be a very different environment because this opportunity to lose real cash tax. So therefore, we are expecting significant penalties, and we've seen the EU draft directive. It actually says the penalties of 5% of turnover of the relevant constituent entity will be applied. And if you've got multiple constituent entities in that European jurisdiction, obviously there's a case of will it be applied per constituent entity or per jurisdiction. So I think there's a lot of unanswered questions on the administration side as well. But in terms of, you know, moving forward and the actions that need to be considered, what we've tried to do, just given the complexity of this, and I appreciate it may feel like a lot to digest, is to try and break these down by actions that you may want to consider immediately, those in the short term, and then those in the more longer or medium term. But really, I think the first step, and many groups are already on this journey now, is to consider how the rules will impact your organization, depending on the structure that you have. So can you take account of any or take benefit of any exclusions, for instance? But the next step is key, and that is, what's the financial impact here? And is it material enough to communicate that with the board? And even if it's not, let's say it's a case where it's the domestic corporate tax that's going to really impact your business, not the global minimum tax. In that scenario, you still will have a significant compliance effort under the global minimum tax, probably a lot more so than under a domestic corporate tax. So therefore, those conversations are really fueling then the discussions with the board, with management, audit committees. And then, of course, how different countries in your structure implement these rules will need to be carefully monitored. And we're pulling together globally a tracker on this that we're hoping to share with our clients as soon as possible. But I think just given how dynamic the situation is, it's something that we're very mindful of needs to be logged very quickly. In terms of the short-term actions, I think it's really just stepping up from the immediate financial impact, the impact assessments that needs to be done, and then obviously working with the various teams. So preparing stakeholders, but also working with the various teams to understand what data challenges you may or may not have, and whether you need any additional resource. And particularly where we don't have tax teams, or we have very thin tax teams on the ground, this is becoming a real issue from a resourcing perspective and a talent perspective. And then I think moving forward, and a lot of groups are already thinking about this, whilst they're discussing this with their boards, it's a case of, what is my disclosure strategy now? I've got public C/C coming in a couple of years, and I now have this, this new requirement to submit my global return, very sensitive information, very detailed information that will be exchanged in all of the jurisdictions that I operate in. So that's become a real concern for a number of groups, particularly when they're looking at their ESG agenda as well. So, re-looking at any transfer pricing here for related party transactions, and also identifying steps, largely from what actions need to be taken from a restructuring perspective or from a related party perspective in terms of transactions. So I think these types of actions are keeping a number of groups busy. And of course, this will only evolve as we get more updates. We've come to the end of this presentation now, and I'm just conscious of time as well, but we will continue to keep you updated from a development perspective. So of course, once we do have the commentary and we do have the subject to tax rule, treaty model, treaty wording, and of course the big elephant in the room, once we do have the corporate tax, if and when we do have the corporate tax announcements, we will of course keep you updated. But Stuart, I'm just conscious of time. I'll hand over back to you because I think we've got a couple of minutes if we do want to take any more.
Yeah, Shaban, while I've got you before I get others on, one constant theme that's come up in the Q&A and also through the private chat is just about the Pillar 2 rules on free trade zones across the region, and where there might be tax exemptions or incentives. How will they interact with the globe rules?
Yeah, I mean, that's a great question, and we keep getting there. So I think I'll try my best to answer this in less than 60 seconds. But I think obviously the UAE has a number of options in terms of wanting to keep those holidays or whether they will apply preferential rates. So they can choose to do that, and in your structure, you may still get those benefits. Therefore, your ETR, assuming the UAE does introduce the global minimum tax rate, your ETR will most likely, given the blended nature of the rules, be dragged down slightly, so it wouldn't be 15%. So in that case, unfortunately, what that does mean by way of the way that the UTPR rule is now designed is that could actually result in a top-up tax being applied to your UAE entities, even if you are headquartered here in the UAE. So I think whilst they will still remain attractive from a domestic corporate tax perspective, there will still be a potential top-up tax to be applied under the global minimum tax.
Thanks, Shaban. And just conscious of time, we've got maybe a couple more questions, but one for Stefan. And this question is someone that's quite excited. Will these rules replace C/C and other TP documentation? Maybe Stefan, you might have a view on that.
Yeah, thanks. And that's a great question. In my view, I don't think they will. So we will still have the traditional CBCR and transfer and documentation requirements. So I think the main difference that we see in these regulations currently is the actual cash impact. So like Shabana already mentioned, substance, CBCR, that's all nice, that's all a reporting tool, but it doesn't really impact my tax positions. So I think this is the big change that we're seeing here now. So there will be an impact on my tax payables. There will be tax payments to be done, and I think this is what will be the additional things that companies need to think about, but it will not replace our traditional transfer pricing documentation requirements. So this will still be there.
Thanks, Steph. I appreciate that. And look, we've just come to the close. There's a question there about who signed the agreement. I think there was a slide in the deck that answered that. We'll circulate the deck around to the attendees. Hopefully that'll pick up some of your queries. So that'll come around by email after this session. And maybe with that, I'll just pass it back to Dr. Rashid to close today's session. Again, feel free to reach out to anybody if we haven't picked up a question and answered it. As I said, we will come back to you on the ones we know we haven't answered. But thank you for your attendance today, and Dr. Rashid.
Thank you, Stephen. Thank you, Shabana team, for very insightful webinar. I think it's a webinar comes with a rich information at the right time. So clearly, this topic it will continue to dominate international tax and transfer pricing agenda for years to come, and may also influence several tax policies in our region going forward. Probably, as you see in the region, our region is getting more complex. We hope you found the session useful, and we'd welcome your feedback. In a moment, you will see a page in which you can submit your feedback, and we will do our best to take your comments into consideration for our future events. As Stuart mentioned, if your question was not answered during session, we will get back to you on one-to-one basis soon after this webinar. We thank you once again for making the time at 10 today and wish you a great rest of the day. Thank you very much and stay safe. Thank you very much. And hope to see you in the next seminar. Thank you very much.